Picture this. You're watching the markets, and suddenly, one of the biggest airlines in the country just goes into a complete freefall. The stock is tanking, alarms are ringing, and everyone is scrambling to figure out what in the world is going on. Well, today, we're going to unpack the perfect storm that slammed right into IndiGo.
Okay, let's get right into it. We are talking about an 8% nosedive in the share price in a single day. Now, for a company this big, that is not just a little bit of turbulence. No, that is a massive, stomach-lurching drop that vaporized a ton of value in just a few hours.
So you gotta ask, what could possibly cause a plunge that dramatic? I mean, this wasn't some slow, predictable slide. This was a sudden, violent shock to the system. And it turns out the answer wasn't just one thing. It was a collision of two major crises, hitting at the exact same time.
All right, so let's break down that first storm front. The first piece of the puzzle, and a huge one for any airline, started brewing deep inside the global energy markets. And this crisis was about to hit IndiGo right where it hurts the most, its single biggest expense.
And that crisis was the price of crude oil. It shot past $115 a barrel. Now you have to understand, for a low-cost airline like IndiGo, this is a code red, all-hands-on-deck situation. Their entire business model is built on keeping costs razor-thin, and fuel is the one cost they can't control. And here's the direct impact. When crude oil skyrockets, jet fuel is right there with it. And in this case, prices more than doubled. Think about that. Every single flight suddenly became way more expensive to fly, putting insane pressure on their finances before a single ticket was even scanned. But believe it or not, that was only half the story.
Just as this fuel crisis was exploding, a second storm front rolled in, this one coming from the world of geopolitics. A conflict thousands of miles away was about to create an absolute logistical nightmare right in the middle of IndiGo's flight paths.
And this really shows you the impossible situation they were in. On one side, you have your costs just exploding because of fuel, and on the other, the very routes you need to fly to make money are getting shut down. There's really nowhere to run. The airline was getting squeezed from both ends. Now, you might be thinking, hold on, isn't IndiGo mostly a domestic airline? How big of a deal could this really be? Well, this chart says it was a huge deal. 30% of IndiGo's flights are international. And of that crucial international business, almost half, 45%, flies directly through that conflict zone in West Asia. This wasn't some far-off problem. It was a direct hit. So you've got fuel costs through the roof and major flight paths completely blocked? What was the actual real-world damage? Let's step into the impact zone and see just what this perfect storm left behind. The immediate effect was just chaos. In only a few days, IndiGo had to cancel over 500 flights. And we're not just talking short hops. We're talking flights to West Asia and even long-haul routes to places like Istanbul and Amsterdam. Their whole network was getting ripped apart at the seams. And this wasn't a one-and-done kind of thing. As the conflict dragged on, the cancellations just became a daily reality. The airline was bleeding 130 to 140 flights every single day. That is a relentless blow to your operations, to your revenue, and of course, to your customers' trust. And if we look at the stock's performance, you can see that 8% drop was really just the climax of a much longer story. The stock was already down 16% over the last month and a really painful 26% over 6 months. This perfect storm basically made landfall on a company that was already struggling. But if you really want to see the damage, you have to follow the money. And the numbers here tell the starkest story of all. The company's third quarter net profit absolutely plunged, down by a staggering 77.5% from the year before, from over 2,400 crore to just around 550 crore. This is the real-world cost of a perfect storm. So, everything looks pretty terrible, right? Fuel crisis, geopolitical mess, canceled flights, profits in the tank. You would expect every single analyst to be running for the hills. But this is where the story takes a really fascinating and, honestly, a pretty unexpected turn. So a brokerage firm, MK Global, came out and they were very clear about the danger. They basically said, look, in the short term, things are incredibly uncertain. We don't know how this conflict is going to play out. So they weren't sugarcoating the risk at all. And yet, in the very same report, they projected a potential upside for the stock of over 43%. So what gives? How is that even possible? With everything we've just laid out, how could anyone be that optimistic? It feels like a total contradiction. Well, the answer comes down to this term, a buy rating. What these analysts are really saying is, yes, the short-term situation is an absolute mess. It's stormy, it's risky,
But they believe the company's fundamental long-term strength is so solid that this temporary crisis has actually made the stock a bargain. They're betting on the airline's ability to fly right through the storm.
And this wasn't just some random opinion from one firm. Even the SEBI chairman, Tuhin Kanta Pandey, was echoing this idea. He pointed out that while the war was shaking things up, India's own fundamentals were strong. He actually framed all the market panic not as a disaster, but as an opportunity. And that really leaves us with a fascinating final question. In the middle of a perfect storm, when everyone is focused on the wind and the waves and the chaos, maybe the real opportunity is in seeing what hasn't changed, the fundamental strength of the ship itself. So the question isn't just if it will survive the storm, but how much stronger it might be when those skies finally clear.